There is no economic tsunami coming. It's a relentless rising tide. And when you look back, you go, oh my God, it's gone up further and further and further. Everyone waiting for the tsunami, if we didn't get it in March 2020, we're never going to have it at all. So you have to realize that there's something different.
The developing world is teetering on the edge of a severe economic crisis, and unfortunately, many impoverished nations are ill-equipped to handle the far-reaching consequences that will ensue. The impact will not only be felt financially but also ripple through society and politics. Imagine a life where essentials like fuel and medicine become scarce, electricity is shut down due to exorbitant costs, and rising food prices devour a significant portion of meager incomes. In such dire circumstances, even a small spark can ignite widespread discontent. Sri Lanka serves as a visible example of how swiftly an economic crisis can lead to societal collapse. But similar sporadic protests are erupting in numerous countries where governments struggle to balance their people's expectations with harsh financial realities. Given the imminent economic depression, experts in macroeconomics and market strategy are diligently predicting which assets can act as safeguards against hyperinflation and soaring prices, especially for essential goods like food. While bartering and trading are likely to regain prominence, many believe that gold, a traditional safe haven asset, will significantly increase in value compared to its current worth. Additionally, some analysts argue that cryptocurrencies, with a total market value of over $2 trillion today, could serve as alternative safe haven assets, providing refuge for those seeking to escape the impending financial storm. Furthermore, Raoul and Mark Yusko shed more light on the worsening economic times and how these developments will impact the younger generation. Their insights offer valuable perspectives on the challenging economic landscape and its implications for future generations.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
So let me put it in the perspective for others to understand what this means. A millennial and a boomer, father and son. The father, when he was 30 years old, was it was about 1980, 81. Then they had record low valuations for the stock market, a P of 7. Record high interest rates, so he saved money to stick it in bonds, made 18% or 15%. Record high credit on corporate debt and really cheap property. So the baby boomer had this huge set of opportunities ahead of him. And gold was pretty cheap too, but was going up quite rapidly. So when you look at the percentage of those assets that they could buy with their wages, we get a number. Cut forward to the son, 32 years old, 2021. They can buy 60% less in property than their parents could for the same median wage. They can buy a lot less of the S&P, a lot less gold. So what are those things? Those are assets. The price of milk must be about the same, but it's the assets. Why assets count is assets are where you save. Those are the things you own that go up in the future and you release the money from, and that's your return on investment. But a young person now can make a lot less investments than their parents could. That is what is going on slowly over time. Your share is becoming less. And that is what's driving the rich-poor divide, because the rich all get access to this free money and can buy more of these assets that go up. The more they go up, the richer they get. The guy on the median income who's 32 years old can't own any of that stuff. It all really started around 2000 when that bubble popped. The Federal Reserve decided that the only way forward was to use interest rates to drive kind of demand. And it was a massive debt boom that followed. That debt boom, as we know, blew up in 2008. And for many of us in the macro world, that was something that we could see. It was pretty obvious it was going to happen. I was one of the people at the core of that, predicting what's going on. And many of the famous people in the Big Short were kind of subscribers of my research service, the Global Macro Investor. We kind of all knew it was happening, but people in the street didn't. So people would come up to me and say, well, why don't we know? And I realized that that information hadn't really got out there. And I realized that I had access to information other people didn't have. And it wasn't fair. And after Occupy Wall Street, the rise of populism, you knew that the power had to be given to the people. The democratization of information was vital. After 2008, I realized that the problems hadn't gone away. The same problems were there, and all the central bank had done was generate more debt by generating lower interest rates, and now they'd started quantitative easing, which is basically the printing of money to try and hide those debts. And it became clear to many of us that the next recession was going to be a big problem. If 2008 was bad, the debt burden was getting bigger and bigger and bigger, so something bad was going to break.
The recurring U.S. debt crisis has significantly damaged its image as a global superpower, raising concerns about whether the dominance of the U.S. dollar outweighs global stability. Placing financial policymaking in the hands of polarized politicians not only harms America but also raises alarm bells about the country's ability to maintain global economic stability. An expert highlights that instead of effectively addressing its own debt problem, the United States has been exporting its domestic crisis to other nations by leveraging the dominance of the U.S. dollar. Mark Yusko, the founder, chief investment officer, and managing director of Morgan Creek, shares his perspective on the economic situation and the role of Bitcoin in resolving these challenges. He offers insights into how Bitcoin presents a solution to the problems faced by traditional financial systems.
The average price of gas that I put in my car was 31 cents. Now, I visited my son here over the weekend, and to get a gallon of gas now here is $4.31. It's the same gallon of gas. It does the exact same thing. In fact, arguably it's a little less good because now it has some ethanol in it, so it's not quite as combustible as it used to be. The gas hasn't changed in that 40 years. What's changed is the currency is less valuable. And part of the story of Bitcoin is that as well. Is when we talk about Bitcoin, we don't talk about Bitcoin in isolation. We talk about Bitcoin priced in dollars. When we talk about the stock market, we don't talk about the stock market price in isolation. We talk about it priced in dollars. So when the nominal value of something increases, sometimes it's not because the value of that asset is rising, it's that the value of the currency you're denominating it is falling. And so it's that subtle, slow, again, theft. And what's really interesting is it's like the tail of the boiled frog, right? If you drop a frog in hot water, it will jump right out. But if you put it in cold water and slowly turn up the heat, its muscles will relax to the point where when it gets to the boiling point, it won't be able to jump out. And that's kind of what happens with this slow, insidious devaluation of the currency. So again, the government job is to extract the wealth from the people that create the wealth, the labor, and they do that through this tax of inflation. Governments will always profligately spend, right? That's what governments do best, is they spend money. And empires rise, governments become more and more powerful, they become more and more concentrated at the top with their cronies, and then empires get so indebted that they have four choices. They can pay the debt back, they can restructure it, they can default on it, or they can devalue it. Well, they can't pay it back because there's not enough revenues, kind of like today, where we're seeing the budget deficit widen and widen and widen. They could restructure it. Well, who's going to take the deal? No one. Okay? They could default on it. Well, if you do that, then you get kicked out, so they can't do that. So the only choice is to devalue. And when you devalue, eventually you devalue so far that the empire fails. Right? The Roman Empire, the Ottoman Empire, the British Empire, every empire. And now we're seeing that happen, I believe, in the American Empire, which is causing this great stress on the monetary system, which is what I believe led to the creation of Bitcoin as a cryptocurrency, different from a fiat currency, because a cryptocurrency has a finite supply, different from a fiat currency, which can be created at will.
The global economy is facing a precarious situation, as warned by the World Bank. The organization has downgraded its growth forecast for this year and the next, citing slower economic expansion. While global gross domestic product is expected to rise by 2.3% this year, higher than the previous projection of 1.7%, it remains significantly below the 3.1% gains seen in the previous year. The World Bank points to a deceleration in economic growth for developed countries, with the United States projected to experience a slowdown due to rising interest rates. Emerging markets and developing economies, excluding China, are also expected to face challenges, with growth estimated at 2.9%, down from 4.1% in the previous year. These countries are grappling with the impact of the COVID-19 pandemic, the conflict in Ukraine, and tight global financial conditions. The World Bank's chief economist and senior vice president, Intermit Gill, highlighted the significant setback for many developing countries. He noted that by the end of 2024, approximately one-third of these nations will still have per capita income levels lower than those recorded at the end of 2019, indicating 5 lost years of progress. This worrisome scenario suggests a turbulent time ahead for the world economy. It raises questions about individual preparedness and actions taken to mitigate potential risks. We would be interested to hear your perspectives and strategies in the comments section. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.